Okay, so let's jump in. And for those of you who haven't met Anna and me, we're data-loving nerds who think real estate is way too old school. So we're the kind of techies that enjoy spreadsheets and skyline views like the ones that you just saw. So together we built a 660 million portfolio across 25 projects. We've earned the trust of about 1,200, maybe 1,300 now, 1,300 uh, geeky investors. They invest with us because we lead with the numbers and not fluff. Here's a glimpse of just about half of what we bought or built. Our team uses data to invest across 8 unique asset types. So types everything from value-add apartments, ground-up multifamily, student housing, fourplexes, built-to-rent homes, townhomes for sale, self-storage, and flex industrial. So every one of these asset types pushes us to learn new skills and think in new ways and get sharper at what we do, which is to protect and grow your investment. Now gone full cycle on 9 different projects, delivering a blended IRR of 33%, average annualized returns of about 40% across those deals. These two that are on the screen are fairly recent, and both happened, in a fairly challenging market. So the model works. And our investors notice a difference. Meet Jennifer. She's an experienced pro. She's seen a lot of firms, big and small, and she believes that we outperform the larger ones, not just in ROI, but in how we run things. She loves our systems, our speed, and the fact that the same core team has been with her since day one. And I think that consistency really matters. Here's Dr. Parak. He's a seasoned general partner who's done many deals, actively, passively. And what stands out to him is the way we use data to drive decisions. His quote in orange actually says it all, right? He sees us as a partner with clarity and ethics, and that's exactly why he keeps coming back. Okay, let's knock out the legal fine print so we can jump into all the good stuff. Quick heads up, this is just education, not advice. We're sharing what we've learned, what we do, but it's not a promise that you're going to strike gold, right? So real estate stocks always come with risk. So please do your own digging, talk to pros before you invest. And if you've got questions, pop them into the Q&A, not the chat, but the Q&A. We're going to tackle as many as we can at the end. And don't stress about taking notes because we're going to send you the replay probably day after tomorrow. All right. Now, you guys might like Trump or you might not like Trump, but you can't ever say that this guy is boring. The kind of horse trading that we're seeing today is a recipe for all kinds of upheaval and uncertainty and nervousness. And that's exactly what we're seeing the markets do. Lenders are feeling it. Brokers are feeling it. Capital groups are staying on the sideline because the Trump card is back. And this is the part where history really slaps us in the face, right? So on the right here, you can see that tariffs jumped to their highest level since 1937, right? So yeah, pre-World War II. So we're now at 16% average on imports, up from 2.4% in January. And this 16% number, it changes daily based on today's tweets from Trump's Truth Social account. And 16%, this is not a ripple. This is a freight train. And yes, I know inflation hasn't reacted yet, but I don't want anybody listening getting too comfy, right? So delayed pass-throughs are real. They're coming. So I'm expecting a bounce in inflation in the coming 30 days, and that might drive up interest rates further. And so far, the economy is actually chill, which I'm happy about. Job growth is steady, 135,000. Unemployment is flat at 4.2. Inflation's actually even dipped to 2.4. But please don't let the calm fool you. This is the eye of the policy storm, the tariff storm. Because all of these numbers lag, the impact comes later. And if you wait for CPI to blink, you're really too late. I mean, this is your time to game plan. If you're close to refinancing a property or buying it, I don't think you should be waiting for lower interest rates because if anything, what I'm seeing in the forward-looking CPI numbers is that rates are actually likely to tick up in the next quarter, not go downwards. And given that inflation has actually been very, very muted in the first 4 to 5 months of this year, first 5 months, the only thing that could be responsible for this graph, right? You see this upward graph. This is April. This is May, sort of, here right now. This upward graph, the only thing that's possible is that markets They're spooked. I like what our graphics designers did here. That's funny. Um, market's just freaking out, right? Yeah, it's dropped a little bit since then. I think it's around 4.4 today, maybe 4.35. Now, for those of you who don't know, both single family and multifamily rates are very deeply tied to this, the 10-year treasury rate and the 5-year treasury rate. So people like us, we obsessively track this rate, and we're very unhappy with where the rate is going because this upward trend, this has nothing to do with inflation data in the last 6 months. It has everything to do with freaked out cat, which represents freaked out market. And it's not just the market that's freaked out, right? It's also all of the forecasters. So we routinely gather forecasts from a lot of different sources, and we presented those forecasts to you in January, right? Right here, right? So you see here. Now, all these same forecasters, they're cutting their forecast for annual GDP growth. Remember, 2% right here is pretty good, right? That's where we were on March 10th. And as of June 10th, that number has fallen to 1.4% for the year. Now, the good news is, so far, the first 6 months of the year, the economy actually outperformed this number. So it either means that this number is just bearish and wrong and we're going to do well, or that the second half is going to look pretty darn bad. And I've been thinking about this, and I don't actually know which way it's going to go because the tariffs are such an X factor that it's very hard to use the data for the last 6 months. All right. So obviously that first mega trend, the first real estate trends, tariffs, was all negative. But the second one is really, really awesome. Yes, folks, this is Oprah level tax generosity, right? So these new incentives are making a comeback, and they're going to supercharge deal math, right? Deductions are flying off the shelves. You get one, you get one, you get one. Real estate folks basically got everything that they wanted out of the tax bill. And we also got some that we wouldn't get. By the way, the slides basically say proposed bills. Of course, now that bill has passed, so you can just take that word proposed wherever you see it. You can ignore that word. So my favorite and the one that is most likely to juice real estate investor returns, of course, is bonus depreciation, right? So yes, bonus depreciation is now locked in. It's back for 5 straight years. And as you can see on the screen, this gray bar was showing that bonus depreciation, which was enacted in the 2027 tax bill, had been going down every year, right? And now 2025 is back up to 100%. And then we stay at 100% pretty much until the end of 2029. This is incredible, right? So we get 5 years of 100% bonus deduction. And there's huge numbers of people that are just going to be buying or investing in syndications in the next 5 years just because of this. It's a huge, huge give. Also, on the left side, big win for high earners, especially if you live in places like New York or New Jersey or California. The state and local tax deduction, SALT deduction cap, it goes up from $10,000 to $40,000. And this is breathing room. I live in the San Francisco Bay Area. I'm definitely saving around $10,000 a year in taxes because of this, right? This means it's much easier for home prices to go up in high tax states. It doesn't make that big of a difference in low tax states, though. Now, what about the right one? This one, QBI, or qualified, business income deduction, right? So this is luckily still alive and kicking. So 23% write-off on pass-through income. So this stays in place. Let's say you earn $200,000 in net income from a rental portfolio or, your syndication fees. And these do qualify as pass-through income, right? Under this deduction, you get to write that 23% off of that amount before taxes. So on 200,000, that's $46,000 shaved off your taxable income. And if you're in a 35% federal tax bracket, that's about a $16,000 in tax savings every year. So nice. Okay, on to the estate tax exclusion boost. So estate tax the exclusion jumps from 23.6 million to $30 million. So that's a 27% boost. This is for couples. And that's really real money that you or your investors can pass on to Uncle Sam, pass on without Uncle Sam crashing the party. So you can use it to transfer, portfolios tax efficiently, and you can lock in the succession values. So if, you're older and you're thinking generation wealth, the clock has just reset in your favor. All right. So I'm done with the two big trends from the last 6 months. Those were the two big ones that are impacting everything. Now I'm going to jump into real estate. We're going to talk about mortgage rates and home prices and incomes. As usual, I'm going to bitch about the growing gap between mortgages and salaries. I'm going to talk about the return of inventory on the single family side. So that's new. And then we're going to jump into multifamily. There's a lot of you here that are here for apartments. We're going to talk about why rent growth is still stalling, still. And we'll talk about occupancy. And then my favorite slide of the presentation, we're going to talk about demand. And finally, we'll throw in a little bit of commercial real estate distress, and we'll chat about loan extensions. All right. So for all of you single family people out there, these are the updated 30-year mortgage rate predictions for the end of the year, end of 2025, right? These are not numbers from today. So this is what all these smart and important people think the rates are going to be for the end of 2025. On the left in green, Fannie Mae continues to be bullish. They think I don't think they think much about the tariff issues, or maybe they think the economy is going to weaken, which is going to force the Fed to cut rates because today's rate is 6.8. So Fannie Mae actually thinks we're going to go down by 70 basis points in 6 months. At the other end of the spectrum, in red here, is Redfin, and they're saying rates are going to be exactly where they are today at the end of the year. No change, right? So take your pick. I think that the reality might be somewhere in the middle. This is our updated slide on home prices. So almost across the board, the smart people out there do seem to think that home prices are going to keep going up over the next 12 months. Redfin's bearish right here, and they're still only at minus 1%. And so I'm not sure about what's happening on this slide. In a few slides, I'm going to tell you why I disagree and why we might see a small decline somewhere between 2 and 3% in home prices. So I'm going to go against the grain. I'm going to say that I'm on Redfin's side here, but I think they're not bearish enough, and we might see 2, 3, maybe 4%. There are two different reasons why I think that we might see a slight downward adjustment in single-family prices. I just don't think that there are enough people out there who can afford single-family homes. You've seen some version of this chart before if you follow us, but I continue to update the chart. So in the last 4 years, you see these 4 years here, right? Salaries have gone up by 25% in the US, and that's actually a pretty good number for 4 years, right? That's a nice increase. But mortgages in the US are up 110%, right? That's just an absurd number. And a lot of that is because interest rates have doubled. And then, of course, home prices are about 45 to 50% in that 4-year time frame, right? So if your salary goes up 25% and your mortgage goes up 110%, how many people are going to qualify? Well, it's not a lot of people, and I can tell you that. So let's start with the green bar. So in the left side, you can see the estimated median price for a new home, right? About $460,000 is the median price for a new American home. Well, this is for a new home. I think this is just for a regular home, not
just for a regular home.
Yeah, just regular, not
average. Yeah.
Yeah. Now you can see in the pie chart, you can see that 70% of first-time buyers can afford a $400,000 home. This is at 460. Even if you're looking at 400,000, 70% of first-time buyers cannot afford it. And it gets worse. Here on the right side, you can see that there are 53 million households in the US that shockingly, today, at today's interest rates, they can only afford a $200,000 home. We are at 460,000 and rising. Do the math. It is looking horrible, truly horrible, for home ownership rates in the United States. And I know that people like me have been talking about rising home prices for a long time, so I can understand if there's a tendency for some people to say, we'll just ignore what Neal Bawa has been saying because he's been saying it for many years and that home prices have actually gone up a little bit. Yes, but something has changed fundamentally. On the left side, here you can see that home buyers earned 17% more than renters, or needed to earn 17% more than renters to qualify. This was in Feb 2021, so almost a year after COVID. And then it went up to 55% by Feb 2023, then 73% more, then 82% more. This is new, right? This is all, this is what it was like before COVID, right? We weren't seeing numbers like this. So when a homeowner needs to earn $116,000 to afford a typical home, and renters only need to earn $64,000, you have a gap, $52,000. And that makes it very lucrative to be a renter if you're earning well. And home buying just doesn't make mathematical sense. It only makes emotional sense. Now, caveat. As they say, God is in the details. As it turns out, the situation is actually really, really bad in some cities and not so bad in other cities. So, for example, if you look at the Chicago, bottom left here, right, the median home payment premium versus the two-bedroom rent is actually not much in Chicago, right? So it's fairly easy to jump that gap, that you see that 20% gap for Chicago and become a homeowner, right? So that's good news for people living in Chicagoland. Now take a look at Vegas at the top, right? So in Vegas, the median home payment premium versus two-bedroom rents is a shocking 150%. So it's the highest in the United States. So it's astonishingly difficult for someone in Vegas to become a homeowner, right? Much easier in Chicago. So same story as Vegas for, Phoenix and Boise and Denver, Austin, Raleigh, Nashville, right? These are the cities where becoming a homeowner is so incredibly difficult, which is why if you're a landlord in these cities at the top, it's to your advantage, right? I don't want to be a landlord in Chicago simply because the gap is too small. People can jump across it very quickly. I want long-term renters. I want forever renters. And I get a lot of these in Vegas, Phoenix, Boise, and very few of them in Chicago. Okay, so I'm now done with my first argument for why I think home prices are actually going to dip in the next 12 months, right? You heard the argument. There's just not enough people that can afford to buy. Here's my second argument. Remember, for years, we've been talking about this thing called the lock-in effect. Anna's heard this a lot of times, right? The lock-in effect is that tens of millions of homeowners like me had locked in extremely low interest rates. So my home's interest rate is 1.75%. So if I basically sell my home and buy it back myself, my new interest rate will be 6.8%. So my average mortgage will jump by $75,000 a year. This means I'm locked in. I'm not going anywhere, right? And lots of people were locked in, but over time that effect loses its effect because people need to move. Divorces, debts, other family reasons, right? That's happened. So now we're beginning to see the market actually adjust, and a lot more homes are finally beginning to come into the market. You see that right here, right? Once again, God is in the details, right? I would not want to be selling in Miami right now. Why? Because this is a buyer's market, right? So is West Palm Beach. Pretty much all of Florida is a buyer's market. So is Austin, right? Huge numbers of homes that have flooded into that market in the last 6 months, right? And obviously, what you're looking at here on the right side is only some cities in the US. Now, as you go further down this list, it quickly turns into sellers markets. So these are potentially buyers markets at this point in the US. So maybe you're somebody who's wanted to buy rental homes in Florida. Now's your chance. And so the second part of this second argument is that this is the overall view of the country, right? So you've seen what happens to inventory for single family homes. Normally, here on the left, right, 2017, 18, 19, we're right around 1.2 million homes in terms of home inventory. And then, of course, COVID happens. We went all the way down to 448,000. That's a crazy, crazy low number. And that led to incredible increases in prices. And now we're here, right, back up above a million for the first time in 4 years. And now that we have the inventory, we are seeing very, very loose markets. We're seeing buyers basically have a lot more power. What's really important, and this number is not, overly high, is these numbers. The projections are that all these homes that didn't flood into the market over those 3 or 4 years, they have to come into the market now. So if we see this number, 1.28 million next year, and if we see that number, 1.53 million, there's no way we can put 1.53 million homes into the US market and not see price declines. This is the second reason why I'm bearish on home prices, and I think that they could drop. All right, done with single family. I'm going to move on to multifamily. A bunch of you guys are on the multifamily side. So the story here is mostly incredibly good, but there's exceptions to that rule, right? So firstly, I'm going to look at this tile, the monthly rent growth, right? 0.26%. You multiply that by 12 months, and you're looking at annualized rent growth of about 3%. Well, that's pretty good in the multifamily industry, right? 3% rent growth is something that we will happily take anytime. But if you look at the tile here on the right, and you look at the last 12 months instead of annualizing just last month, Well, this number really sucks because 0.7% rent growth in the last 12 months means that rents are not even keeping up with inflation because inflation is at 2.5%. And historically, rents move up faster than inflation.